welcome along to the Property Academy podcast. I'm your host, Ed McKnight.
And I'm Andrew Nicol.
And on the show, we're talking about bubbles, and not the sort that we're going to be drinking at the red carpet event, which is coming up. We're talking about housing bubbles. Now, I had an Instagram message through Opus from Harrison, who is a listener of the show, who had a question around housing bubbles, because just last week or the week before, there was an article from Bloomberg Wealth, which is a big American media company, produces a lot of financial reports, sells those terminals that you see at share brokers. And this article was talking about the different level of bubbliness across a number of different countries. And Andrew, where did we come on this?
Well, we came number one, Yoo-hoo, which is not as good as it sounds, right?
Not when it comes to housing bubbles. And look, here's the thing. We've done a lot of talking about the property market recently on this podcast. So I don't want this show to just be about the property market, but I thought we do need to cover this because we had a lot of you asking about it. And of course, we always have a policy on the show, Andrew, that if somebody asks a question, we might as well answer it. So what are we going to cover in today's show? We're going to go through how this was calculated, a couple of critiques about what you can and what you can't interpret from this specific article. And then we're going to go through perhaps a better way of assessing the level of bubbliness within a property market. So let's get into this. I want to talk to you first about how the index was calculated and the metrics that they used in order to be able to bring it all together. And there were 5 in total. So the first thing they were looking at was price to rent ratios. So compared to where they have been over the long term, have prices shot up relative to rents? Prices to income ratios, which was the same as before in terms of how it was calculated with that first metric. The lift in real and nominal house prices, so the percentage that house prices have increased over a short period of time. And then also the growth in credit. So what do I mean by that? I'm talking about the growth in the level of debt that's out there, the number of mortgages and the value of mortgages that are being taken out. And I guess what they're trying to do here, Andrew, is use some of these as measures to ground house prices and to say, well, perhaps house prices should be relative to some of these measures. And I think I can see that, but there's also a couple of arguments on the other way as well. So what I want to know is, what do you think about, are these the right measures to be used when ascertaining whether house prices are at an unsustainably high level, which might indicate whether it's a bubble or not?
Well, so we've got 3 critiques. Now, did you cover off what was included? I wasn't listening to you.
Yeah, I waffled on about that.
Good,
yes,
good.
I did.
Okay. Well, two of them.
So you see, you never listens to me.
Oh, we've been married too long to listen to you. There are 2 which are practically the same. There's real price growth and then there's nominal price growth. So, I mean, really, it's only 4 measures. So they've got 5 measures, we'll call it 4, and they're taking an average across all of them, and it assumes that each one is as important as the rest, which I don't know is actually fair. And again, we're not bagging this. We're just saying that, there's maybe some more to the story. And I guess when you're producing content like this, there's a mixture of not wanting it to be overly complex, but you're also wanting it to be accurate. So, the data's accurate, but I guess how it's presented is in quite a simplistic way.
And so I guess is what you're saying there, Andrew, you've got the data here and they've ran it, we assume, correctly, but that doesn't necessarily indicate whether a particular housing market is bubbly or not.
Yes, that's exactly what I mean. One of the things that this doesn't include is the affordability of debt, and that's a major contributing factor to whether or not, a house market is sustainable, I guess, and maybe accessibility to debt as well. So price to rent ratios can increase, but of course that has no impact to an investor if you're investing in that market. The other critique we've got is that it assumes that these were the right measures to use. And while we'd agree on the fact that some of them are quite good, some of them maybe aren't. So, if I think back to the GFC days, that came because there was a lack of credit all of a sudden, and that really kind of stopped the housing market in its tracks. Probably unemployment is a big one for me. If people don't have jobs, they can't afford to pay their mortgages, they can't afford to pay their rent, and that probably would be a higher measure from me. And credit growth is probably another part of this, and so New Zealand actually came 17th out of 23 for credit growth, so it's in the bottom 30%. So whilst there is some other factors here which are, I guess, you could say negative or not as good as other countries. There's some positives there, and I think the debt part is a huge part of that.
And so what I guess we're kind of saying with that is we've seen massive house price growth, but it hasn't necessarily been fueled by people taking out a whole lot more and more debt. Now, let me be clear. There are a couple of people who listen to the show who I know for a fact have taken out a hell of a lot of debt in order to be able to gear up and buy a whole heap of properties. But as a whole, New Zealand, actually over the last couple of booms, has not fueled that increase in house prices by taking on more and more debt. Now, you're probably thinking, well, how do house prices increase if we as a whole are not taking on a lot of debt? And there are a couple of different ways it can happen. Remember that as house prices increase, if you sell your house and then go and purchase another one, then you've potentially got a couple of $100K more worth of equity in order to be able to go and purchase another house. So you only have to take out an extra $50K worth of mortgage or add an extra $50K onto your mortgage in order to be able to go and purchase a more expensive house and push up that marginal house price. It doesn't take that much debt to increase house prices once you actually sell your house for a higher price. So how does it increase before that? There are two different ways this can happen. New Zealand is a beacon for very, very wealthy people. In fact, my understanding is there's something like 200 billionaires, or somebody's going to fact check me on this, but there are a high number of billionaires who want to come into New Zealand, and the government's trying to line them up in order to invest. Now, it doesn't take that many people selling their 2-bedroom apartment in Shanghai and moving over to New Zealand and buying a massive house to start to push house prices up. Those people then sell their houses for more money than they ever thought they'd be able to. They either move to Tauranga or they move down to Wellington, some other area, perhaps outside of Auckland, and start to push house prices up there because they've got good spending power because they just sold to somebody who came in from overseas. Perhaps they take on an extra $50,000 worth of debt, buy a house down the road, push that house up by an extra 50 grand. It doesn't actually take a lot of debt to push up house prices when you've got money coming in from overseas. And that's what we tend to see, especially in our bigger and more expensive housing markets like your Auckland, like your Queenstown. And so that's why what I think this one misses is the fact, yes, we've had a lot of house prices, but we've had a lot of returning Kiwis who have brought equity, who have brought capital into the country. So while, sorry, Andrew, I'm on a roll now. So while expectations have increased and house prices have increased, it's almost not unsustainable because it hasn't been fueled by debt compared to the likes of France, which has had almost twice the level of increase in credit growth and almost twice the increase or the rate of increase in terms of how many mortgages are being taken out. And yet, according to this metric, they wouldn't be seen as bubbly, which I think is the real missing point, which you've got to think about when you're ascertaining, do we have a bubble here in New Zealand?
Yeah, and actually I think that probably a big part of this that we need to remember is New Zealand's response to COVID has put us on the map. Like, let's face it, probably before COVID, you could talk to 1 in 10 Americans, and I remember this from my Las Vegas trip, the ones that recognised your accent either thought you invented Lord or Lord of the Rings. That's about the only things that they could connect with you. Now, of course, everyone knows who New Zealand is. And so as a result, we are a country in hot demand. When these borders open, we are going to be inundated. I think we already are, we're being inundated with applications to come here. So I guess it's kind of to be expected.
I don't want to bash it too much, but I do want to say, well, what is the alternative way to assess whether we're in a housing bubble or not? And I think we're probably both in agreement in that there needs to be significantly more analysis about the underlying fundamentals. So one of our big critiques was that it ignores the affordability of debt. So if the price of debt has halved, which it has now, and ANZ came out just a couple of days ago, earlier this week, decreasing the floating rate to 1.69% for new build properties. I mean, the price of debt is so cheap that of course prices are going to go up. And so the net position of investors may be exactly the same. The cash flow for investors may be significantly more improved. And so of course you're going to start to see people move in there. And these are just the factors that haven't been counted. So I'm a big fan of the Reserve Bank inquiries that are going on at the moment, where they're trying to create measures and determine, well, what is the right way to see the sustainability of current house prices? And I'll say it again, in the latest financial stability reports that came out from the Reserve Bank, from the central bank, they said there is a degree, this is a quote, a degree of sustainability at current levels, because what they're doing is saying, well, we need to look at, are people making a rational decision to purchase a house compared to, well, do I rent or do I buy a house? And if those things are relatively in line as they are right now, then that shows sustainability. So we probably need to look at some other things. First of all, what's the opportunity cost of buying a house? What's the price of rent? Are they roughly in line from an owner-occupier perspective? And then we also need to look at, well, how does that compare? How does the decision to invest compare to the alternatives that are out there? Shares, term deposits, savings, and again, roughly in line is what we'd expect. So we do see a degree of sustainability, certainly within house prices. Now, what I want to know, Andrew, is how would we go about interpreting this further? So if we were the editors at Bloomberg, what would we do here?
Change the data, probably.
I don't want to hear you abusing that data, mate.
No, seriously. I guess one of the things to bear in mind is, this scales them, but it doesn't necessarily show the difference between New Zealand and somewhere else. If the scale was 1 to 100 and New Zealand was 100 and the next one down is 50, we've probably got and I don't like using the word housing bubble because I don't think they exist, but, we've probably got something of an issue. If we, on the other hand, are 50 and then the next one down, which was Canada, I think from memory, is 47, then, okay, well, it's probably not the end of the world, not worth crying about. So I guess at the end of the day, this type of article, we're not saying they're worthless, but they're probably just something there to create a bit of a discussion. I don't think I would hang my hat on this being something that then I would go, oh no, the housing market's ruined in New Zealand, I wouldn't be investing there. And I think one thing I've learned from being slightly older than Ed is you always hear articles when the market starts to heat up, you start to see these housing bubble articles, and then the market will level off and it might go back again a little bit if there's tightening of credit policies, and then it goes flat for a wee while, and then it takes off again, and then there's articles of housing bubbles, and then it goes flat again, and you get my point, right? This happens over and over again. There is always going to be a finite amount of land. There's always going to be a demand for houses because we need them. So I don't believe in housing bubbles personally. Ed, the economist, might challenge that and give me some data.
I would definitely not quote you on that, but
I don't care.
But I think it is useful as well to just realise as well that media organisations have to pump out this sort of stuff. And actually 5 days before this article came out talking about housing bubbles, another one was published by the same organisation, Bloomberg, with the title, Yes, real estate prices are soaring, and no, it's not a bubble. Now, admittedly, that was about the US market, but the bubble indicators can start to come out. Things can start to look like a bubble as things heat up without it actually being a bubble. And I think that's important to note.
And the US were number 7 on the list. So, they have a lot of the same challenges that New Zealand have, right?
Yeah. Now, the other thing that I think this is useful for that I want you to think about as well, it helps us think, well, what is the biggest risk to New Zealand house prices at the moment? I'm going to venture and say it's expectations. So because a lot of the increase in house values has come not from debt that people are taking on. Admittedly, though, a lot of people who listen to this show, I'll say it again, are very comfortable taking on a lot of debt in order to gear up and buy a lot of houses, which I'm totally okay with. But because we haven't seen massive increases in the amount of credit, we haven't seen massive increases in the value of mortgages taken out, then a lot of it comes down to expectation of what do I think a house is worth, and what does Andrew think a house is worth, and what does Joe down the road think a house is worth, because it's really about what we're willing to pay for it. And of course, when you've got shortages and you see massive price increases and things are going crazy and volumes, they're up too. It's very easy to have those high expectations, but if expectations change about what a house is worth, if we start to think, it's not actually worth that, if people aren't out there buying, that's where the housing market would have an issue. It's all about expectation. So that would be the top risk I see in New Zealand in terms of what could potentially make us really concerned. But look...
Well, hang on. So in your mind, what would stop people buying then?
I would say if there was some significant, isn't this funny? I was going to say significant legislation,
We'll never see it.
catastrophic events. It's really hard to say. I would say a massive exodus of people to Australia. Say if the borders opened and lots of New Zealanders moved over to Australia seeking higher wages. If there was a brain drain in New Zealand.
Yes.
If there was even more significant policy than what we're talking about, legislation coming out. I'm talking about limiting the number of houses that somebody can own.
Higher tax rates.
It'd have to be significantly higher tax rates.
I don't know. It's getting there. I'm practicing my Australian accent as we speak.
LVRs at 20%, needing 80% deposits, things that would really shake confidence within housing. But at the same time, if you had that, then the economy would go down extremely quickly, and the Reserve Bank would have a real problem on their hands because nobody would want to spend because we would feel like wealth was decreasing. And look, I know we've been rattling on about this topic for quite a thing, but it was interesting. We were talking, we were out for dinner last Monday, Andrew, at a wonderful Italian restaurant. They're romantic. It was a pity that Lauren was there. And I couldn't believe that in little old Christchurch, oh my God, it's 8 p.m. and this on a Monday night and the Italian restaurant's full.
Absolutely chock-a-block. We had to sit at the bar for half an hour before we could get a seat because it was chock-a-block.
And I said, Andrew, where have all these people come from? Do you remember what you said to me? You don't remember?
No.
He says, people aren't saving as much anymore because you don't need to save because your house is going up in value.
We feel rich.
And of course, you do need to save. Let me just be very clear. You need to save. But I can understand if Joe Bloggs down the street feels rich now because his house went up by 20 grand.
Yes.
And now he feels, I can afford to spend because I just saved 20 grand.
Out on Monday night. Yeah.
Hey, look, let's wrap it up there. But just before I ask you to rate, review, and subscribe, I need to talk about other things.
We've got something serious to talk to you all about.
You thought we were talking about bubbles bursting. Now my heart's bursting. Why is that? Because I need your help. I just logged on last night to Apple Podcasts to check the ratings, and the pain I felt because 4.8 is our current average, down from a
better than a 4.8.
We were an average for 5 for almost a year and a half. So, hey, I do need your help. I'd love for you to jump on Apple Podcasts and please give us a 5-star review because I need to get the average up. The pain it caused me in my heart, I need your help there. And look, in return, we'll turn up again tomorrow because we're going to have a list of the show. Gareth is his name. Gareth is an investor, and we're going to have him on the show to talk about his story. So make sure you tune in on that. And remember, we do have our webinar coming up this coming Tuesday, actually. Tuesday, 7 p.m. We're talking about the upcoming government legislation. We're going to do a deep dive in there, and we're going to talk about the opportunities that are still there for investors. So tap or swipe over the cover art, be a link in there. And of course, I'll see you tomorrow. Thanks for listening to the Property Academy podcast. I'm your host, Ed McKnight.
I'm Andrew Nichol.
And we're going to be back again tomorrow with even more daily strategies, tactics, and insights to help you get the most out of the New Zealand property market. Until next time.